All right, hello and welcome to Founders on Finance, episode number 1. Today we have Kanishka Maheshwari, who's the CEO and co-founder of InterPrime. How you doing? He's going to go ahead and talk about a little bit on his founder's journey, why he decided to start InterPrime, and then we're going to talk a little bit about what managing company cash has changed pre-COVID to post-COVID, and talk about something that he's created called the SIPs, which is a standard investment policy for startups. So how are you today?
I'm good, Mike. How are you?
I'm doing wonderful, wonderful. Another day in paradise down here in Fort Lauderdale. Where are you calling in from?
I'm in Menlo Park and it's gorgeous here. It's 70 degrees, sunny, and it's the middle of February. Well, actually, it's early March, so can't complain.
Time flies when you're having fun during COVID, right?
Right.
Exactly.
Right, exactly.
Well, cool. Why don't we start with like a little bit of a background on you? Why don't you kind of tell us about you a little bit, why what InterPrime does, etc., and then we'll kind of get into the meat and potatoes.
All right, sounds good. So I'm Kanishk. I'm a technologist, engineer by training, and then a product manager after that. I worked at Salesforce for a long time, and I've been like a quintessential investments and finance geek ever since I was a teenager. I bought my first stock when I was 14, and I should have held on to it, instead of selling it for a quick buck. But I started InterPrime, I would say, almost 3 years ago now, and we started with the simple idea that all companies, big or small, should have access to the same level of treasury services that the behemoths have, like Apple's, Google's, IBM's, and these companies have been enjoying this stuff for decades, whereas some of the smaller companies, they've kind of not had access to that same expertise. And our goal is to provide that to startups and small and medium businesses.
Power to the people, right?
Yeah, exactly. Right. And yeah, of course, the benefit is that we can leverage technology to do this, right? And help us scale across smaller customers, which
Right.
in the past, 20 years ago, only IBM could do it because they had, the experts in-house, and they were able to kind of do everything manually, where smaller companies couldn't.
Right. Totally makes sense. Yeah. So let's get into like kind of the founder journey, right? You're obviously a wonderful addition to the United States as an Indian immigrant. Can you
That's
kind of
right.
walk me through the thought process of why you'd want to leave your family, and then obviously all the great universities that are there. It's not a hop, skip, and a jump really from India to Carnegie Mellon in my hometown of Pittsburgh, where you went to higher education.
Well, it was pretty simple, really. I wanted to study computer science. I wanted to come to the US to study because the best schools are here. And I was lucky enough to get in. you know, if I hadn't got in, I wouldn't be here. So I applied, I got lucky, I got in, and yeah, here I am.
And here you are. I mean, I can tell from my side, I was supposed to go there on a basketball scholarship and did not, and then I could not get in. So +1 for you.
They substituted all the humans at in the basketball team with robots.
Right, exactly. And then from your schooling there, like how did you transition to Salesforce? Was that like your natural progression? Was it like
Yeah,
your
so a friend of mine, interned at Salesforce, she talked highly about it, and Salesforce was coming to campus to recruit. So and this was like in 2006. So, because of her, I learned about Salesforce. She told me about the company, how good it was, and most importantly, she told me about what they were doing. And that's when I realized that, oh my God, cloud is a real thing. And all the business software that was previously being installed onto computers and, in on-premise data centers, that would just go away. And looking at the Salesforce software, it was very clear to me that everything was going to be like Gmail, because Gmail had just come out, a year or two before that.
right?
So if email was going to be in the cloud, then everything else was too. So I was like, hey, once again, I'm getting lucky. Someone told me about this great company that seems to be doing all the right things. Let me just join.
Right. Love it. And what were you building there? My due diligence
Yeah.
kind of seems a little bit of revolving around search and things like that. Why don't you kind of give people some more background on that?
Yeah. So, when I started at Salesforce, it was a fairly small company by today's standards. There were less than 1,000 people there, less than 200 people on the engineering team, and most people were generalists. They were working on all different pieces of the product. I was originally working on something that has now become the Service Cloud. So it was the case management system and the support ticketing system and so on and so forth. But then a few months after I was there, they were spinning up the search team, and I, was very interested in that area. Just big data, search, natural language processing, and so on. So I kind of joined that team. And then I was lead engineer on the search engine, and then I led product management on the search team for many years. I also built the A/B testing framework that Salesforce uses, and the big data system built on top of Hadoop. So big data mostly and automation is my expertise.
Right. You were definitely at the company during the growth period, right? So like the rocket ship years, if you will, right? How did you come to the mental decision to say, hey, Salesforce is obviously a great company. You're working on something super interesting. The company's continuing to grow. Like, what makes you shift gears and say, hey, you know what? I'm a finance geek by heart. Like, why am I going to transition and jump into trying to be a founder? And go down, YC and all that type of stuff.
Yeah, well, I mean, I was, like I said, very lucky to join Salesforce when I did. I was there for over 11 years, and I've always had the founder itch, and I figured like, hey, if you've got the itch, you got to try it. My passion is finance and technology, so voila, let's try to do something that kind of meshes the two. And one of the benefits of being a founder is that you can drive the direction of the product and what you want to work on and what your company does. So that's why we did finance and technology.
Right, makes sense. And with the going through YC and all that, what was your take on that program? It's obviously very well known. A lot of great companies are coming out of there, consistently, Airbnb, et cetera. So what was your take on that? And,
YC was great. YC was great. It was like a pressure cooker though. It took what we would have done in probably 2 years and compressed it into 3-4 months. In terms of product development, fundraising, customer acquisition, and so on and so forth. And it was really, really fantastic. And it kind of really gave our startup the chance to kind of get to the next level, to get out of that incubation stage and, survive a little bit, and thrive even as we kind of got out of that.
Right.
So highly recommend it for everyone. But, let's just say it's not for the faint of heart.
Right. Well, you got to go through the fires to get to the wins, right?
I mean, it's a lot of fun. I mean, I did, I think, 4 or 5 all-nighters during those 4 months, and it's not because, maybe I kind of had to, but it was fun to do it. It kind of reminded me of being in college again, where you're like, oh, I'm working on this thing. I'll just keep working.
Right. Really fires up the passion and like trying to really go after it, make it happen. Right. And that was like coming up on 3 years ago now, right? So InterPrime has kind of seen.
Well, 2 years since YC. 2 years since YC.
2 years worth of YC. Okay. So over that time, you saw a good bit of how companies are managing cash pre-COVID, which I'm sure is going to be completely different than post-COVID. So why don't you kind of walk us through a little bit of what companies were doing, that you were seeing at InterPrime, managing their cash pre-COVID?
Yeah. So for us, pre-COVID, the strategy that we had all of our clients in was a very straightforward US Treasury only strategy, where we invested their capital directly in US Treasury bills of a short duration, anywhere from 3 months maximum up to 6 months. And the reason for that is that those rates were very high at the time, close to 2.5%. And the spread between US Treasuries and any other credit product like corporate bonds and such was very low, only to the tune of 0.2 to 0.25%. But, it would come with, if you did get a slightly higher rate, but it would come with liquidity challenges, credit challenges, diversification challenges, and other risk issues. So we told our customers, don't worry for that extra, 0.1 or 0.2%, stick with US Treasuries, safest security in the world, super liquid. You can get your money out tomorrow. And most importantly, you control all of your capital instead of it being sitting in a bank account or in multiple bank accounts on the balance sheets of those banks.
Right. Kind of putting the CEO and the founder and the company more totally in control of their funds as of giving it away,
Yeah,
if you will.
that's exactly right. Right. So every customer has an investment policy. And then, we InterPrime would execute against that investment policy and, follow all of the rules to be compliant with what is the best way for that company to manage the cash in the safest, most secure way, earning market rates of return, right? So you never have to go to your bank and ask them like, why are you charging me this much? Why are you not giving me this higher interest rate? I'm going to switch to another bank. None of that BS, right? You go directly to the market, you cut out the bank, you control the capital. It's your money, right?
Right. Absolutely. Absolutely. When you're speaking my language, I think that's the way it's supposed to be, And then, with COVID, obviously my background is being in, Wall Street, right? So I understand, rates go substantially lower, et cetera. Can you kind of, explain a little bit more of like how that kind of shifted managers and founders managing their cash?
So here's what happened, right? Like as soon as COVID hit, the spread that we just talked about between corporate bonds and US treasuries that was previously 0.1 or 0.2% blew out. It became 1%, 1.5%, 2% in some cases, because everyone was kind of dumping those corporate bonds in a panic because they wanted to get cash. And because we were in treasuries, we didn't have to worry. We made a lot of money very quickly, in fact, because the rates on treasuries dropped significantly because of significant demand. And two, it gave us the opportunity to pick up some of these corporate bond assets at very good prices and, lock in good rates for our customers going out 6 months, 1 year. So, what we saw, to answer your question more directly, the shift that we saw for our clients was we shifted from a treasury only strategy to a strategy that included buying high-end investment grade corporate bonds. So these are bonds that are issued by the big banks, primarily JP Morgan, Wells Fargo, Goldman Sachs, and then the big tech companies, think Microsoft, Apple, Google, and so on and so forth.
Right. So companies that are very well known, very established, very strong balance sheets, revenues, et cetera, right? So
keep in mind that this is the highest piece of paper on the capital stack. So in order for someone who owns this corporate bond to not get paid back, those companies would have to declare bankruptcy, number one. And number two, even if they did declare bankruptcy, you would be the first person to get paid back their money.
Right. Yeah.
So very safe, very secure. In fact, like some of these bonds, they're also called commercial paper, and they are part of the group of securities known as money market securities or cash equivalent securities when they are, in duration of 3 months or less.
Understood. So the equivalent of having cash in your pocket, even though these are a financial instrument.
The US GAAP accounting standards will account for this when you have 3 months or less, including it in corporate bonds of high investment grade quality as cash equivalents.
Right. Understood. Interesting. And then what about this? I'm trying to think, from the founders themselves, right? They're pre-COVID, they get a COVID, and they now start maybe looking for more yield, maybe start exploring these different types of assets, which totally makes sense to me. But what do you see some of the most common things that people are failing at or not doing properly when they're managing their corporate cash? You see them maybe stretching for yield, trying to get more yield than they should by being too risky, or have you seen over these years some common traits that happen?
Yeah, good question. So, of course, people do stretch for yield, and we recommend to not stretch for yield because, the goal of that money that you have is to invest in your business, right? It's not to eke out an extra 0.2 or 0.25% by taking risk, right? If you can do it in a way that improves your risk management, then you must do it, right? If you can take lower risk and increase your yield, you must do it, right? Because that's your fiduciary responsibility as a founder, as a board member. But you don't want to take additional risk because that's not what the money is for. And so we see sometimes people trying to go for that. We see sometimes people trying to buy assets that are not considered cash equivalents or money market securities. We see people trying to buy stocks, index funds, and other such securities. In fact, some people we know have also purchased some amount of cryptocurrencies, not just Bitcoin, but other such tokens with a small portion of their capital. But they've definitely done that, and we recommend to not do that.
Right, right. That makes sense. Is that something you're going to think about offering at some point? Custodian
So
Bitcoin or something like that?
it depends, right? Like on why the customer wants to buy those securities, right? If it's with their corporate cash, we recommend to not do that. If it's with a piece of money that they are using exclusively for speculation, then it's kind of their call. But with corporate cash, shouldn't really be buying such securities.
Right. Totally makes sense. It's all about making sure the cash is as safe as possible, because without cash, your company is basically done.
That's correct. That's right. You don't want to be in a situation where you need to draw down cash to invest in an initiative and you don't have access to it, or it's reduced by 50% than what you thought it was.
Right. Absolutely understand that. Do you think that there's any correlation between how a founder's personal background is with finance? Does that correlate towards how they manage their corporate cash? I'm thinking like if somebody is super conservative with their personal monies, they may then also just naturally want to be very conservative with their corporate cash. Do you see that? Is that something that's happening? Are they different?
Well, I don't really know about, how a lot of people manage their personal money, but one of the things that we've seen is that, once people understand that corporate cash needs to be managed and not just like kept in various bank accounts, that's when they realize that, hey, we should have an investment policy, and we should manage risk, and we should make sure that we get market rate of return on our capital, right? So I think the key is to understand that corporate cash needs to be managed and it should not be neglected.
Right.
So when founders and other entrepreneurs understand that corporate cash needs to be managed, that's when we can kind of help them.
Right. Yeah, I would imagine a lot of founders may be hesitant because they don't think they either have the knowledge or the proper ways to actually manage it. You keep mentioning something called an investment policy. I know what that is, right? But a lot of the people listening to this may or may not. Do you kind of want to retouch on the what an investment policy is real quick?
Yeah, absolutely. And just to kind of answer one of the things you said earlier was, yeah, one of the big things is that people don't want to make a mistake with their investors' money, right? That's totally expected, normal, right? And the default place really is the bank account, right? Like that's where the money gets wired. So it probably should be fine to keep it there, right?
Right.
And that's kind of the inertia. So it's totally fine. It's like you said, it's partly an educative process that we are undertaking to explain to the community that, hey, there is something better that you can do than keep your money in a checking account, right? And now to talk about an investment policy. An investment policy is it's a simple document that kind of describes what you can do with your corporate cash, what you cannot do with your corporate cash, and who manages your corporate cash, right? Think of it as a compliance document that kind of lays out very clearly what to do with the money, how long, where to invest the money, how long the duration of the assets should be, and who's in charge of making these decisions, right?
Right.
And that's the document. In fact, at InterPrime, we've published our learnings in a document called the SIPs, the Standard Investment Policy for Startups, that kind of outlines all of these things. It's available on our website. You can just go download it anytime, interprime.co/SIPs, and you can just customize that with the name of your company and you're ready to go. You have an investment policy.
Right. Yeah, I imagine that's awesome, just because I know a lot of people, or they're a little scared probably to try to go down that undertaking of creating an investment policy. They probably think it costs a lot of money. They don't know who needs to be involved with that process. And you guys have basically kind of like cleared the decks for them and said, hey, you could start with this for free, with or without InterPrime, and kind of gets them on the path that they could ultimately use it in changing.
Absolutely. And we've got a bunch of VCs, law firms, and fractional CFO groups to kind of approve this policy, right? They've reviewed it. They say that, that it makes sense. It's the right thing to do. And, they've kind of put their stamp of approval on it.
Right. So I guess furthermore, then, like, one of the main benefits of it is, you've taken all the work off their plate to institute this thing. They immediately get the benefits, and then furthering the benefits is, it probably helps them show their investors and board members that they're doing the right thing with the money, et cetera.
Yeah, so exactly. That's exactly right.
A win-win-win all across the board.
Yeah, it's like they're just being proactive with their investors' money, making sure that it's, managed in a fiduciary capacity.
Right. Awesome. Well, I think we're coming up to our 20-minute mark. We were trying to keep it to 20 minutes today, right?
That's right.
Any specific places where people could connect with you, reach out to you on the socials?
Yeah, you can just find me on LinkedIn under my name, Kanishka Maheshwari, or you can get me on Twitter at DJ Mojo Ryzen.
DJ Mojo Ryzen.
Yeah, shout out to Jim Morrison right there.
I love it. Well, that's great, man. I'm glad we got to connect, talk about InterPrime, your background and all that, and where you're moving forward with the company. I think it's going to be great for you, and I recommend everybody checking it out.
Thank you, Mike.
Thank you, sir.